Right. Before we get into anything else, I want you to do something. Open your last pay slip, look at the column that says gross pay. Then look at what's actually landed in your bank account. That gap, that's not an accident, that's not an admin, that is by design. The UK tax system does not treat all money the same. Not even close. The money you drop for every single month, your salary, your wages, your overtimes, is taxed harder and faster than almost other kind of money in this country. And the really gutting part, the people with the most money pay a lower effective rate than you do. Not because they are bending the rules, because they know the rules and you were never taught them. Today we are pulling back the curtain on exactly how the wealthy in the UK legally keep hold of their money and more importantly what that means for you. Let's crack on.
Part 1. Why your salary is the worst way to hold money, approx. 30 seconds. Right then, let's start with why you're getting absolutely stitched up every single month. If you earn a salary in this country, the tax system is pointed squarely at you, mate. Income tax, national insurance, student loan repayments, it all gets nicked before you see a single quid of it. Earn over 50,000 a year and you're handing over 40 pence of every extra pound you graft for. To make matters worse, since 2021, the income tax thresholds have been completely frozen and won't budge until 2028. As inflation pushes wages up, you're quietly dragged into higher tax brackets without single rate changing. The government just freezes the thresholds and lets inflation do the dirty work behind closed doors while your actual spending power gets absolutely hammered. Part 2. The journey of every pound you earn. Let's follow a single pound that you earn, because when you see the full picture laid out, it's actually quite something. Income tax and national insurance come straight off the top, meaning you're already down to about 60 pence before you've even seen it. Then you spend what's left, and VAT instantly takes 20% off most things you buy. Fill the car up with fuel, and you're hit with fuel duty plus VAT charged on top of that duty. You're literally paying tax on tax. Save up to buy a house, stamp duty bites you for thousands. Sell a property later on, capital gains tax hits. And when your time's finally up, inheritance tax takes 40% of your estate. By the time that £1 goes through the full UK tax system across a lifetime, the government has quietly taken the vast majority of it, compounding heavily against everyone who earns and spends normally. Part 3. What the wealthy actually do differently. Now let me show you what the wealthy are actually doing, because it's surprisingly straightforward once you break it right down. There are essentially 3 things they do very differently from everyone else. The first thing, they don't take big salaries. Most wealthy business owners pay themselves as little as possible. Often right around the personal allowance, £12,570, sitting just below the threshold. So there's no income tax at all on their personal income. Their company might be turning over millions, but their personal income on paper is almost nothing. Sounds mad, but it's completely above board. The second thing, they put money into assets rather than pulling it out as cash. Instead of extracting money from a business and getting taxed on it, they use that money, or more often borrowed money, to buy things that grow in value. Property, shares, other businesses. Things that quietly appreciate while they get on with their lives. And the third thing, and this is the one that changes absolutely everything, they never sell. The moment you sell an asset, you've created a taxable event. Capital gains kicks in straight away. So instead of selling, they borrow against the asset's value. They access the wealth without triggering any tax whatsoever. None of this is particularly complex when you lay it out like this. The principles are dead simple. They're just not part of the conversation most ordinary people are having about money. And that gap in awareness,
This
right there,
is where
the
everything
divide between
genuinely
the wealthy and
changes.
everyone else actually begins. Part 4. Buy. Borrow. Die. Right, let's put the whole thing together properly. Buy. Borrow. Die. 3 stages. Stage 1, you buy. You acquire assets that go up in value over time. Property is the classic UK example, but it could be shares, commercial property, a business. You're typically buying with leverage, a mortgage, a loan. You're using the bank's money to control an asset, and you're not liquidating your own capital to do it. Stage 2, you borrow. This is where the whole thing really comes together, mate. As your assets increase in value, you borrow against that growth. That's refinancing, and the critical point here, the loan is not income. You do not pay income tax on borrowed money. Full stop. Let's walk through a straightforward example. You buy a property for £200,000. Over the next 10 years, that property rises to £350,000. You refinance at 75% of the new value. That gives you a new mortgage of roughly £260,000. You pay off the original mortgage, and you've just released over £100,000 into your hands. There's no sale, there's no capital gains event.
The asset controlled without liquidating any personal capital whatsoever. Simple principle with an incredibly powerful compounding effect over time.
Now take the released money and do it again. Buy another asset, let it appreciate, refinance, repeat. Each cycle the pot gets bigger. The tax bill stays at zero. Stage 3, you die. And this is the blunt bit, but it's where the strategy fully comes together. When you pass away, your assets go to your heirs. The debt attached to those assets reduces the estate's value for inheritance tax purposes. And with proper structuring in place, trusts, family investment companies, business property relief, the tax on that transfer can be significantly reduced, and in some cases removed entirely. Part 5. What you can actually do about it. Now I know what you're thinking. That's all well and good for the properly minted lot, but what's it got to do with me? More than you'd reckon, mate. A landlord with one buy-to-let in Sheffield is running the exact same fundamental strategy as the wealthiest people in this country. The numbers are different, but the mechanics are bang on identical. So here's what you can practically take from all of this. First, if you're running a business or self-employed, you probably want a specialist accountant, not a generalist who does a bit of everything on the side. Someone who actually understands extraction strategies and proper tax planning. The gap between an average accountant and a genuinely good one can be tens of thousands of pounds a year. The people at the top have always known this. It's about time everyone else did too. Second, start thinking in assets rather than income. Every financial decision you make should go through one simple filter. Does this pay me once, or does this build something that keeps growing? A salary pays you once. An asset compounds. It's not complicated, it's just not taught. Third, get clear on the difference between good debt and bad debt. Consumer debt, credit cards, car finance, buy now pay later, get shot of it as fast as you can. But debt attached to an appreciating asset where someone else is helping service the repayment, like a tenant covering your mortgage, that's a completely different animal. That's not a liability, that's a proper tool. And fourth, start now.
That wraps up this week's insights. We've covered the key principles for building lasting financial trust. Thank you for joining. I'll see you next week.